Today's lesson will be Chapter 14, Problem 3B. I'm sharing with you my Excel spreadsheet that I've made up for Problem 14-3B. And in Problem 14-3B, they have given you amounts for the face value of the amounts of the bonds. The face value is $65 million. In this problem, the contract rate of interest or the stated rate of interest is 12%. This 12% would have to be divided by 2 because it is the interest rate that we will be using to calculate semi-annual interest off of these bonds. So we're going to be paying interest semi-annually on the bonds. So we would divide 12% by 2, which will give you a 6% annual interest rate on the bonds. The bonds also have a market rate of 10%. Notice that the contract rate of interest, the amount of interest that we're going to be paying back in interest, is larger than the market rate of interest. When the contract rate of interest is larger than the market rate of interest, the bonds will be selling above the face value for the cash amount, which will be more than the face value amount. So it's all about the interest rates. You might remember from a lesson before that the contract rate of interest is actually stated in what we call the bond contract, which is sometimes referred to as the bond indenture of a corporation. So the contract rate of interest is 12%. That's what we pay the interest on. But when the bonds are actually sold, the market rate of interest, which is really driven by investors' ideas about the economy and how well the economy is, the market rate of interest is different. So when there's a difference between the contract rate of interest and the market rate of interest, the bonds will sell above or below the face value. In this case, because the contract rate of interest is more than the effective rate of interest, the bonds are selling at a premium. They're selling for more than this face value amount. The life of this particular bond is 10 years. You'll remember that our interest payments are completed semi-annually. So what you have to do is determine the number of periods in the life of this bond. And we would do that by taking 10 years and multiplying it by 2 to get 20 periods in the life of the bond. In the first part of this problem, they want you to record a journal entry for the issuance of the bonds, and the date of issuance is July 1st. And you need to also take into consideration that the end of the fiscal year is the end of the calendar year, which will be December 31st. But we're actually selling the bonds on July 1st. So on July 1st, we need to make a journal entry to record the sale of those bonds. And so what we're going to do is we're going to debit the cash amount for the amount that the bonds actually sold for. And this amount here was actually given in the problem. So when we get ready to look at Cengage, this amount will be given to you in the problem. This is also what we call the present value of this bond issue at this particular time. And later on in this problem, they'll ask you to calculate this amount by hand, And I'll show you how to do that in just a few minutes. But in this journal entry, all we're doing is we're showing that we sold bonds. The amount that we are receiving in cash for those bonds that we have sold is $73,100,469. Because the contract rate of interest was higher than the market rate of interest, the bonds will sell at a premium. A premium on bonds payable is what we call an adjunct account. We discussed this in a previous meeting. An adjunct account will add to the face value of the bonds on the balance sheet. And I'll also show you that in just a minute. The premium on bonds payable amount is determined by finding the difference between the amount that the bonds payable's face value is and the amount that we received in cash. So the difference between these two figures here is $8,100,469. It's a plug figure, in other words. The bonds payable, of course, would be credited because it's a liability for $65 million. The $65 million is the face value. The $65 million is also the one-time payback amount that we're going to pay back at the end of the life of the bond, which is 10 years. So 10 years from now, we got to pay back $65 million to our bondholders, which are considered to be the creditors of our corporation. We now have this cash amount that we can use to invest in our operations of the business. That's the whole reason that we would sell or issue bonds. But in the agreement, when we're selling a bond, is that we're going to pay interest off of that bond if the market rate and the contract rate are different, and they are. And so the contract rate of interest is what we're going to pay the interest on. So in this particular example, we're going to have to figure out how to pay bond interest. This in a block here that I've outlined for you is going to show you how to calculate the bond interest if you've forgotten. We're going to take the face value of the bond. We're going to multiply that by the semi-annual interest rate, and that will give us the bond interest payment. We're going to do that in just a minute. Also, we will amortize any premium or discount over the life of the bonds. We also talked about this a little bit in one of the previous meetings, or one of the previous videos that we've done. But when we amortize something, we're writing it off, and we're going to write it off over the life of the bond, which is really 10 years or 20 interest periods, if you want to think of it like that. Down here is a notation about what happens when there are bond discounts or what happens when there are bond premiums. In this problem, we didn't do a bond discount. The last problem that we did, 14-2B, had to do with a bond discount. But in this problem, we're working with a bond premium, as we've already discussed. And the reason for the premium is because we have received more cash than the face value of our bonds. When we amortize a premium, we're going to reduce the premium by debiting the bond premium account and crediting the interest expense account. It's exactly opposite of a discount. With a bond discount, you debit interest expense and you credit the bond discount to reduce it. But yet it's the same because we're still reducing the difference between the face value and the cash amount that we've received. In this particular problem, we're working with a bond premium. Bond premiums normally have credit balances. To reduce a bond premium, to write it off, we would reduce that account by debiting the bond premium account. and therefore the interest expense is going to be decreasing. What you're really doing is you're taking this amount of cash that you've received off of the issuance of the bonds, and we are bringing it down to the face value by the end of the life of the bonds. It will be reflected in what we call the carrying value of the bond, that we determine this amount on the balance sheet. So when we get ready to do the balance sheet, we will determine the carrying value of the bond. And if there is a premium involved, the carrying value of the bond will decrease to the face value by the end of the life of the bond. These are just some notes that you need to understand about this chapter. For requirement number 2 in Cengage, they wanted you to journalize the first semi-annual interest payment and the amortization of the bond premium at December 31st, the end of the first year. So we've gone from July 1st to December 31st. We're actually going to have to pay back some interest. As an instructor, it's easier sometimes for students to see the 2 journal entries separate. The first journal entry that I've got recorded here is to journalize the semi-annual interest payment. This second journal entry is to show you the journalization of the amortization of the bond premium in this particular problem. So I choose to show my students both of these entries separate. But unfortunately, in Cengage, they wanted you to combine both of these entries together and just make one journal entry on Cengage. But I want you to know that these 2 entries are combined together, and that's what they want you to write down in Cengage. But it's still important for me that you understand how they get the amounts too. So I'm going to show it to you separate first, and then we're going to combine it together. So first of all, we got to determine the first semi-annual interest payment. To find the amount of the interest payment, we're going to take the face value of the bond and multiply it by the semi-annual interest rate. Now remember, in your problems, they're giving you annual interest rates here. And we're talking about interest, so we're talking about the contract rate of interest. If we take the contract rate of interest, which is 12%, and we divide it by 2, that will give us the semi-annual interest rate. In other words, 6% of the face value of the bonds in this problem, which was 65 million. 65 million times 6% will give you 3,900,000. So again, we're taking the face value and multiplying it by the semi-annual interest rate, which is 6%. That will give you an interest payment every 6 months of $3,900. Our interest expense would be debited and our cash would be credited. Now notice in the journal entry that I've given you, I called it bond interest expense because that's what it is. Interest expense could also result from notes payable. But in this case, we're talking about bonds, so I just want to make it clear to you that we are talking about bond interest expense. Even though on Cengage, they just use interest expense, I think in the real world, it would be important for you to notify or show that this interest expense was going to be paid to bondholders. Bondholders are the creditors of the company, so they're similar to note holders. And so I guess that's why Cengage said just put it in interest expense. But I like to show it as where the interest expense is coming from. So we sold bonds. This is bond interest expense that we're dealing with here. The second part of requirement A is for the amortization of the bond premium. We are reducing the bond premium on our books, which will also reduce our interest expense, because the premium is a adjunct account to the bond payable. The adjunct account premium normally has a credit balance. When we're amortizing it or writing it off, we would have to reduce this account by debiting it. That's why I've debited it for $405,023. Now, in order to get this amount of $405,023, what I did is I took the total amount of the bond premium, which was $8,100,469. I'm going to divide that by the number of amortization periods in this bond issue, which would be 20 periods. If you divide 20 into $8,100,469, it will give you $405,023. We're reducing our premium, and we're also reducing the amount of the interest expense. Now, in Cengage, when they want you to do the combined entry, you'll notice that the bond interest expense is debited when there is a payment of interest, but it is credited when there is a premium that's been amortized. So the difference between $3,900,000 or $3,900,000 minus $405,023 will leave you with the total amount of the bond interest expense that is going to end up on the income statement as interest expense. But excuse me, we were actually looking at the amount of the bond interest expense. And again, that's the bond interest expense that was debited less the bond interest expense that was credited for the two of these when we made them as separate entries. The difference between these two is the bond interest expense. That's the debit. The premium on the bonds payable is $405,023. We just put that in to that box. And when you add your debits together, your total credits is for the amount of the cash that you paid out, which was just for the interest payment, which was $3,900,000. In the second part of requirement number 2, in the B part, they're also wanting you to make a journal entry for the second semi-annual interest payment and the amortization of the bond premium at July 1st in the second year. And again, it's going to be this very same journal entry that we completed in the A part, because you're making a interest payment for 6 months from January 1st to July 1st. And I see I've got a mistake in this. This should say July 1st. I'm sorry, class. It should say July 1st here. And so we're at July 1st. In the second year, we are paying our bond interest for 6 months, and we are amortizing the premium for an additional 6 months. It's the very same entry that we calculated before. So our bond interest expense on July 1st will be debited for $3,494,977. Our premium will be debited for $405,023, and our cash will be credited for $3,900,000, just like we did in transaction A. So in requirement number 3 in Cengage, they want you to calculate the interest expense, but that interest expense is for the first year. So ignore this year. We're going to the interest expense for the first year, and you can see in the combined entry, it gave you $3,494,977. So at the end of the first year, our interest expense on the income statement would be in this amount. Our balance sheet accounts that would be affected are our long-term liabilities. Our bonds payable would be recorded at the face value, which was given, and then at the end of the first year, only the end of the first year, our premium has been reduced by $405,023. It was originally $8,100,469, but at the end of the first 6 months, we amortized that. We reduced that premium by $405,023. The remaining balance in the premium at the balance sheet date is $7,695,446. Since the premium is an adjunct account, we add it to the bonds payable to get the carrying value. The carrying value of the bonds payable at the end of the first year's life at December 31st is $72,695,446. What will happen is the carrying value will go down each year until it reaches the amount of the bonds payable at the end of the life of the bond. So over the years, over the next 10 years, the life of the bond issue, we will be decreasing the premium, which will decrease the carrying value down to the face value at the end of the life of this bond. Now, even though they did not ask you to prepare the balance sheet portion, I thought that was something that you need to know how to do. In the next part of this problem, we're going to be calculating the present value of the bond issue for this particular problem. And so you might remember from the last time that we spoke, I gave you some notes about how to calculate the present value. They came in steps. In step number 1, what we're going to be looking at is calculating the present value of the lump sum amount or the face amount, the one-time payback amount, which is your face value. To calculate the present value of the face value, we're going to need to look at the tables that Cengage has given us. We're going to look up on our tables the semi-annual market rate of interest. The semi-annual market rate of interest for this company is 5%. The annual rate was 10%. We divided it by 2 to get the semi-annual rate, which is 5%. We're going to look on our table at 20 periods because the life is 10 years, but we're paying interest and we're also amortizing twice a year. So there will be 20 periods in the life of this bond issue. So in order to find the table value of 0.3769, we're going to have to go to the intersection of 5% for 20 periods. I'm going to refer back now to your Cengage problem to show you how we would have gotten this table value amount, because that's where your tables are. They're located in Cengage. So bear with me just a minute. I'm going to stop sharing this. And I'm going to go to Cengage. I'm going to share this with you. And we're really down here at our tables. Since we're looking for the present value, the face amount, that's the lump sum table. The lump sum tables were table 1 and table 2. I don't know why they gave you table 2, because you don't need it. You just need table 1. So I'm going to click on table 1. I'm going to look for my interest rate, which was 5% for 20 periods. The table value amount is 0.37689. That's how I got your spreadsheet amount that I have outlined on the spreadsheet as 0.37689. This is the table value for the present value of $1, the one-time lump sum amount, the present value of the face amount. We use this table, which was table number 1. The market rate of interest was 10%. We divided the interest rate by 2 because we're paying interest semi-annually. So 5% is the amount of the interest rate, and we will go down to 20 periods, and where the table intersects, the row intersects with the column of 5%, we're going to get the table value amount of 0.37689. We would then multiply this amount by the face value, and that will give us the present value of our lump sum amount. So write this down. The table value amount is 0.37689. We will take that table value amount, 0.37689, and we will multiply this by the face amount, which was given in your problem. The face amount of this bond issue is $65 million. And that will give you the amount that they want you to put into the present value of the face amount. So it's $24,497,850. In order for you to find the present value of the semi-annual interest payments, we would have to know what the interest payments were first. Then we would look up the table value amount and multiply the semi-annual interest payments by the table value amount. Now, what you have to realize is that the interest payments will be reoccurring all through the life of the bond. They are equal amounts that we are paying in interest every 6 months. So that makes them an annuity. So what you're going to do is you're going to look at table 3, which is the present value of the annuity. We're going to take the market rate of interest, divide it by 2 to get the semi-annual rate of interest. We're going to go down 20 periods, and that will give you the table value amount. It's important to find the table value amount. Then you will multiply the table value amount by the semi-annual interest payment. So bear with me just a second. There's really 2 parts to the calculations of this. So I'm going to go back to our face value, which was given in this problem at 65 million. I'm going to multiply this first by the contract rate of interest, which was 12%, but since we are calculating semi-annual interest, we've got to divide this 12% by 2. So I'm going to multiply my face value times 6%. This will give you your bond interest payment amount. Write this down. Is $3,900,000 is your bond interest payment every 6 months. We have to know this before we can determine the present value of the interest payments for this particular problem. So this is your interest payment amount. Write that down, $3,900,000. The next thing we've got to do is we've got to find the table value for an annuity, because interest payments are equal amounts over the life of the bond. We use the annuity table, which is table 3. I don't know why they give you table 4. You don't need it. You don't need table 2 or table 4 in this problem, but you do need table 3. Notice table 3 is an annuity table, present value of the annuity table. This table value, you're going to take the interest rate, which is the, you're going to take the market rate of interest, which I forgot what the market rate of interest is. So I'm going to go back to your Cengage, and we're going to look at the market rate of interest. Bear with me, class. The market rate of interest is, let me get my face out of the way here, is 10%. So it's 5% is your market rate of interest. So on table number 3, you're going to be looking at the market rate of interest, which is 5% for 20 periods, which is 12.46221. I would write that down. This 12.46221 is going to be multiplied by the semi-annual interest payment that we calculated at 3,900,000. So in Cengage, we're going to take 3,900,000, which was our interest payment amount. We're going to multiply it by the table value of 12.46,221, and that will give you the present value of the interest payments, which is 48,602,619. Then the price that you receive for these bonds is the combination of the present value of the face amount plus the present value of the semi-annual interest payments. So 73,100,469 is the amount of the price that you would receive for those bonds. Notice this amount is equal to the cash amount that they received for the bond issue. So you have a way of checking to make sure that you've got the price received in there right. These two parts combined together are the price that you will receive for the bonds. The rest of this problem is just recording what you had on your Excel, on the Excel spreadsheet in these blanks. And I don't think that's real necessary to do. So I'm going to stop sharing this with you. You can get the information to fill in these blanks from the Excel spreadsheet that I've already shown to you. I will be attaching this Excel spreadsheet with your videos for this chapter. So if you want to, you can look at that closer on your computer at home. You could even print it out if you wanted to, so you could see what to enter in for the amounts for Cengage. So I hope this has helped you in learning about the transactions, the journal entries that we would record for the issuance of bonds, as well as calculating the interest that we have to pay on the bonds and amortizing the discount or the premium on the bonds. So I'm going to stop sharing now, and we'll see you next time for the next problem. Bye-bye.